Last night, the President of the United States stood in the cross hall of the White House and told the American people that the core strategic objectives of the Iran campaign are approaching completion. Within 2 hours of that speech, crude oil futures jumped 5%. Asian markets opened deep in the red, the Nikkei down 1.4%, the Kospi down 2.82%, and the spot price of silver climbed 3.6%, touching $77.85 an ounce. Not because hostilities are winding down, because the market finally processed what the president actually said. There was no ceasefire. There was no timeline for withdrawal. What there was a promise to strike Iran with extreme force for another 2 to 3 weeks, a reference to bombing them back to the Stone Ages, and a floating of the idea that the United States might walk away from the Strait of Hormuz entirely, leaving 35 nations to figure out how to reopen a waterway that moves 20% of global oil supply. The British Prime Minister called an emergency diplomatic session within hours. France refused to participate in any military operation to reopen the strait. Iran's president issued a public letter claiming his country holds no hostility toward other nations, while his foreign minister told Al Jazeera that Tehran is not pursuing a ceasefire. It intends to end this war on its own terms. This is not a conflict cooling off. This is a war crossing into its most unpredictable stretch. And every ounce of physical silver sitting in a COMEX vault right now has become one of the most strategically significant assets in the entire Western financial system. If you don't understand why yet, stay right here, because I'm about to connect a set of data points that nobody on financial television is willing to put in the same sentence. I'm JON AG. No sponsors. No bank research notes written to protect a trading desk you'll never see. No advisors earning commissions off your confusion. Just the raw data, the documented sequences, and the questions every silver holder deserves answered before their next move. If you're new here, hit that subscribe button below, because what you're about to hear is not airing on any financial broadcast tonight. Let's start with the number that defined this week: 76.4 million ounces. That is the total registered silver currently sitting in COMEX-approved vaults as of March 31st, 2026. Registered means deliverable. Bars with warrants attached, serialized, hallmarked, ready to transfer against a live futures contract. 76.4 million sounds significant until you stack it against the number sitting directly above it on the same datasheet. 577.7 million ounces. That's total open interest. Paper claims, futures contracts, each representing 5,000 ounces. Run the math and you get a coverage ratio of 13.2%. For every 100 ounces someone on a trading terminal believes they hold, 13 ounces physically exist in deliverable form. The paper leverage ratio is 7.6 times. And the COMEX Stress Index, a composite measure combining coverage ratio, inventory trend, paper leverage, and vault outflows, currently reads 85. The all-time recorded high is 88. We are 3 points from the ceiling of documented physical stress in the history of this exchange. And here's the detail that transforms a data point into a headline. Registered silver dropped 13.1% in the last 30 days alone. That's 11.6 million ounces physically pulled from the vaults in a single month. At the current pace of withdrawal, the depletion clock reads 139 trading days, not calendar days, trading days. At the start of this year, that clock was reading over 200 days. It has been accelerating through a war, through a price collapse, and against every incentive the exchange has tried to deploy to slow it down. Now, let me take you inside the vault that mainstream financial media consistently refuses to examine. On January 7th, 2026, COMEX delivery notices showed JP Morgan issuing 99% of 8.1 million ounces across 1,624 contracts. One bank, One day, nearly the entire volume of silver changing hands. This is the same institution that paid $920 million in fines in 2020 after the Department of Justice found it guilty of manipulating precious metals futures through spoofing. The same bank whose physical silver stockpile is now estimated by multiple analysts at over 750 million ounces. Much of it accumulated between 2012 and 2019, when silver was pinned between $14 and $20 an ounce. They spent 7 years quietly buying cheap silver, while their own trading desk was actively suppressing the price. That's not a conspiracy. That's a $920 million settlement on the public record. And now they are the single largest issuer of delivery notices on the very exchange they helped build. You are watching the same institution that distorted this market for a decade, now positioning itself to be the last entity standing when registered inventory runs out. Whether that makes you angry or genuinely impressed is your call, but you need to see it clearly before you make any decision with your money. Here's what makes this week categorically different from any week that came before it. 44 silver trading firms in Rajkot, India, the center of Gujarat's bullion trade, formally declared insolvency in late December and early January, carrying combined liabilities of 3,500 crore rupees, approximately $425 million. These weren't fringe speculators. These were generational trading houses that had been holding short positions, betting silver would never cross 1,25,000 rupees per kilogram. Silver blew through that level and kept running. The margin calls arrived. A settlement meeting was convened on a Saturday night. Some traders locked their shops and vanished. The resulting liquidity crunch spread into real estate and private lending markets across Rajkot, Ahmedabad, Indore, and Dubai. One industry manufacturer told The Print that if silver prices don't retreat within 3 months, the damage will reveal who has already drowned, naming Rajkot, Agra, Indore, Kolhapur, Vapi, Mumbai, and Coimbatore as the cities that will absorb the shockwave. This is what happens when paper pricing detaches from physical market reality. The short sellers weren't entirely wrong about the paper price direction. The CME raised margins to $32,500 per contract on January 7th, triggering an 11% intraday crash. The paper price cooperated. The physical market did not. On the same day, COMEX showed silver at $72. Physical bullion dealers in Japan were selling for $130 an ounce. Dubai was clearing north of $100. Shanghai premiums held at $8 above the Western benchmark. An 80% premium between the paper price and physical delivery in Tokyo. That is not a functioning unified market. That is a confession that two completely separate pricing systems are now operating simultaneously under the same ticker, and one of them is lying. Now let me show you why that gap is going to widen, not close. On January 1st, 2026, China implemented the most aggressive silver export controls it has issued since its rare earth restrictions. The Ministry of Commerce published a whitelist of exactly 44 state-approved companies authorized to export silver through 2027. To qualify, a firm must have annual production capacity of at least 80 tons and hold government licensing approval. Hundreds of smaller and mid-sized refiners that previously supplied the global market are now locked out entirely. China controls between 60 and 70% of the world's refined silver supply. Elon Musk posted on X that the restrictions are harmful and that silver is essential across a wide range of industrial processes. A state-run Chinese publication cited an unnamed industry insider confirming that the new policy formally elevates silver from an ordinary commodity to a strategic material, placing its export controls on the same regulatory footing as rare earths. Think about what that means. This is not a tariff. This is not a temporary quota. This is the nation with dominant global supply explicitly declaring that silver is now a tool of economic statecraft, alongside rare earths antimony, and tungsten. And the timeline is not short-term. The whitelist runs through 2027 with no announced expiration. The demand side of this equation has not paused for a single day of this war. Solar panels consumed roughly 30% of total annual silver supply in 2025. The IEA projects global electricity demand from data centers, artificial intelligence infrastructure, and crypto mining to double by the end of this year alone. Silver is embedded in the switchgear, the relays, the circuit breakers, the thermal management systems, and the power distribution networks of every data center being built across 3 continents. There is no commercially viable substitute at manufacturing scale. Now here's the number that should be keeping every commodities analyst up at night. Samsung's solid-state battery program uses a silver-carbon composite anode. Stanford University published research on January 16th in Nature Materials showing that a nanoscale silver coating just 3 nanometers thick makes solid-state electrolyte surfaces 5 times more resistant to lithium intrusion damage. Current lithium-ion electric vehicles use between 25 and 50 grams of silver per vehicle. Industry estimates suggest solid-state batteries could require approximately 1 kilogram of silver per 100 kilowatt-hour battery pack. Samsung is partnering with BMW on next-generation evaluation vehicles in late 2026. Toyota is targeting solid-state production between 2027 and 2028. If solid-state batteries reach even 20% electric vehicle market penetration by 2030, that translates to 514 million ounces of new annual silver demand. That single number is roughly equivalent to the entire current annual industrial silver consumption on Earth. Solar already owns 30% of supply. AI data centers are doubling power draw this year, and now battery factories want a kilogram per pack. This demand pipeline is not speculative. It is funded, blueprinted, and actively under construction. Let me put the COMEX delivery data in perspective, because the scale of what's happening inside these vaults has no historical comparison. In all of 2025, COMEX processed 474 million ounces in total deliveries, more than double the 203 million from the year before. December alone cleared 65 million ounces, a single-month record. January 2026 followed with 49.4 million ounces, more than 7 times the historical average for that month. And here's the detail that should unsettle anyone still characterizing this as a normal market cycle. January is classified as a minor delivery month. March is also classified as minor, but March recorded the highest deliveries for a minor month since last May, when tariff uncertainty was generating massive spread arbitrage. The distinction between major and minor delivery months has completely lost its meaning. Buyers are pulling metal every single month in volumes that would have set records just 2 years ago, and they are not pausing to consult the paper price before placing the order. The people standing for delivery are not solar panel manufacturers pulling raw feedstock. A COMEX 1,000-ounce bar is a serialized, hallmarked, institutionally documented monetary artifact carrying a chain of custody stamped by Engelhard, Pamp Suisse, Johnson Matthey, or Asahi. Whoever is draining these vaults is accumulating them strategically and methodically, without a single public statement explaining the reason. In the first week of January alone, COMEX warehouses saw 33.45 million ounces withdrawn in 7 trading days, representing 26% of registered inventory disappearing in a single week. And here's the behavior that defies everything a standard market textbook would predict. Traders are rolling contracts backward from March to January and February for immediate delivery rather than waiting for later months. That is the opposite of normal market behavior, and it signals urgent, almost desperate demand for physical metal right now. But I'm not going to give you only one side of this trade. Your capital deserves honesty, not cheerleading. So, here is the bear case, delivered with the full respect it deserves. The SLV ETF, the largest silver exchange-traded fund on the planet, has shed over $3.6 billion in assets in 2026. 1-month net outflows stand at $1.94 billion. 3-month outflows reach $2.44 billion. The fund has recorded outflows for 3 consecutive weeks, losing over $713 million in the most recent week alone. The SIVR Silver ETF has had outflows for 6 straight weeks, losing over $623 million. That is institutional money actively unwinding silver exposure. Gold logged its worst monthly decline since 2008 in March, and silver fell harder, because silver always falls harder. That's mathematical reality given silver's higher beta relative to gold. The OECD published a report warning that headline CPI could jump from 2.4% to 4.2% later this year if energy prices continue climbing. If inflation runs that hot, the Federal Reserve cannot cut rates. Markets have already priced in 0 rate cuts until June of 2027. 12 months of expected accommodation erased in 3 weeks. A strengthening dollar makes silver more expensive for every non-dollar buyer on Earth. Rising treasury yields increase the opportunity cost of holding any asset that doesn't generate income. And every leveraged trader who rode last year's 147% rally is now facing margin calls they cannot absorb. The consensus analyst forecast from ING, Saxo Bank, and HSBC clusters between $55 and $70 average for 2026. JP Morgan projects silver averaging $81, but acknowledges massive downside volatility. If the war ends tomorrow, if the Strait of Hormuz reopens, if oil retreats below $80, the entire inflation-driven rate repricing unwinds. Rate cut expectations return. The dollar weakens. Liquidation pressure evaporates. The bear case is structurally sound in the short term, and you must account for it. But here is what the bearish thesis cannot answer. The vaults did not refill when the price collapsed. Silver fell from $121 in January to $67 in mid-March, a 45% crash, and registered inventory kept draining. 11.6 million ounces left in the last 30 days alone. Backwardation did not resolve. The spot price remains above the futures price across the entire forward curve through late 2026. Every contract is inverted. The market is stating clearly that physical metal in hand right now is worth more than any paper promise for future delivery. Lease rates, which historically sit below 1%, spiked to 39% in October 2025, ran at 8% through January, and remain multiples above historical norms. The 5-year cumulative supply deficit exceeding 800 million ounces does not reverse because a war repriced the Fed's rate path. Nobody cancels a solar farm. Nobody pauses a chip fabrication plant. Nobody redesigns a solid-state battery anode because of a futures margin hike. Industrial demand is inelastic to the paper price and now represents over 60% of total global silver consumption. And then there are the sequences. The documented, time-stamped, publicly verifiable sequences that no one in financial media will connect in the same paragraph. Let me show you what I mean. But first, look at the money flowing in the opposite direction from those SLV outflows. 5-day SLV net inflows just turned positive at $370 million, even as the paper price was dropping. Sprott Physical Silver Trust holds over 200 million ounces, with a net asset value north of $15 billion. In January, Sprott doubled its at-the-market equity program to $2 billion, enough to acquire approximately 18 million ounces of physical silver at current prices. That's roughly 16% of total COMEX registered inventory through a single institutional capital raise. Money is moving toward allocated physical exposure, while paper ETFs bleed assets. That divergence tells you everything about where institutional conviction actually lives. The paper is being sold, the metal is being bought. Those two sentences describe two completely different markets operating under the same ticker symbol. Now here's the sequence. The CME raised margins on January 7th. Silver crashed 11% intraday. JP Morgan issued 99% of deliveries that same day. The Federal Reserve's standing repo facility processed $74.6 billion in emergency lending on December 31st, a record 50% higher than the previous all-time high. That facility exists to provide short-term liquidity to eligible financial institutions. Only certain banks qualify. The margin hike, the crash, the delivery dominance, and the emergency lending all converged within a 7-day window. Then the Financial Times reported a $580 million bet placed on falling oil prices, 15 minutes before the president posted about pausing Iran strikes on March 23rd. Someone had advance information and used it to front-run a presidential announcement. These are not theories. These are documented transactions reported by the Financial Times, COMEX delivery records, Federal Reserve H4.1 balance sheet releases, and ETF creation and redemption disclosures. You can verify every single one. The question isn't whether these events happened. The question is whether you believe they all happened by coincidence inside the same 7-day window. So here's where things stand as of April 2nd, 2026. A war is entering its most dangerous phase, with the president promising to strike Iran with extreme force for another 2 to 3 weeks, while floating the possibility of walking away from the Strait of Hormuz entirely. Oil is holding near $100 a barrel. The Fed is frozen, the dollar is surging, and the paper price of silver is being crushed by the exact set of conditions that validates the fundamental argument for holding it. Meanwhile, underneath all of that wreckage, registered COMEX silver sits at 76.4 million ounces, with 139 trading days on the depletion clock. Backwardation stretches across the entire forward curve. China has walled off 60 to 70% of global refined supply behind state-controlled export licenses. 44 Indian trading houses have already gone insolvent from betting against the physical market. JP Morgan has accumulated what analysts estimate to be the largest private silver hoard since the Hunt brothers. And 514 million ounces of new annual demand from solid-state battery factories, facilities that haven't even started pulling from the supply chain yet, are waiting in the wings. One of these realities is wrong. The paper price says silver is overvalued at $77. The physical market says you cannot buy a single ounce in Tokyo for less than triple digits. The futures curve says immediate delivery is worth more than any promise for later. And the vault data says registered silver is depleting faster now, during a war-driven crash, than it was during the rally that preceded it. When the war ends, when the dollar eases, when the Fed finally signals accommodation, and when paper liquidation reverses, the physical market that never stopped draining will still be sitting underneath, with 139 days of registered silver in a demand pipeline that just added battery factories to the list of claimants. The snapback will not be gradual, it will not be orderly, and it will not wait for permission from the same institutions that told you silver would average $32 in 2025, while it was busy rallying 147% to an all-time high of $121.67. If you made it this far, you're not watching casually. You are part of a community that reads vault reports, tracks lease rates, counts the bars leaving the building, follows delivery notices down to the contract level, and understands the difference between a paper price engineered by margin requirements and the physical reality of a metal the entire modern economy cannot operate without. That distinction is your edge. Guard it. If this video showed you something your nightly news never will, hit the like button. Share it with one person who still thinks the spot price tells the whole story. Subscribe if you haven't already, and drop the words JON AG in the comments below. Not for the algorithm. Because when the next viewer scrolls into this video and sees that phrase repeated 1,000 times, they know instantly that this community doesn't skim headlines. It reads the data, it watches the vault reports, it verifies every claim, and it stays until the last word, Invest with logic, never with noise. JON AG, signing off.